have you ever considered using SMT when you're analyzing for the RBV model? And there's been a month when I think that I received at least 50 messages from 50 different people asking me about whether I use SMT or not. And I was like, okay, this is a divine sign. I have to look into SMTs because, yeah. Okay, so this was like the long story short. So now I'm thinking about, just like I said earlier, starting with the basics about the SMT logic, and then the logic behind reversals and continuations. Okay, so if you guys have questions, by the way, while I am explaining things, by all means, just stop me, ask me. Okay, I don't mind. Just please make sure that you're not going to ask questions, you know, two of you at the same time or something like that. Okay, so like I said, let's first start with the basics. Okay, so we have three types of SMTs, right? So what we're gonna do in here, we're gonna consider that on the top we have gold, and on the bottom in here we have silver. Okay, so this is gonna be gold, and on the bottom we're gonna have silver, right? So SMT, like I said, we have three types of SMTs. Okay, so the first type of SMT implies that we're gonna be looking at gold making a higher high, okay? And then silver is not making a higher high anymore, okay? So in this case, gold making a higher high, but silver being unable to make a higher high anymore, obviously, this is something that we would want to see when the price has already been rallying, okay? So this is something that you want to see in a bullish market, okay? Why? Because this is a bearish reversal divergence, okay? So this is a bearish reversal divergence. Now, bearish reversal divergence means that gold is trending higher, so is silver, okay? And obviously we're going to use, like, mentally, we're going to use silver as the indicator, okay? So basically gold is creating higher highs and higher lows, so is silver, okay? Now, at one point, there is going to be some sort of price, you know, gold going higher, okay? But that's not going to be a break of structure anymore, like it was here, for example, okay? Now it is, because think about it like this. What is usually happening in a bullish market? Price is creating higher highs and higher lows. In other words, this is a market structure. It's broken to the upside, then price makes a pullback, doesn't break the previous higher low. And then this high in here becomes a drawn liquidity. And once it's broken to the upside, it becomes a new break of structure. Okay. And then you wait for another pullback. And then this high becomes a drawn liquidity. And then price just goes higher and it continues to break structures to the upside and respect structures to the downside. Okay. This is the underlying way in which a bullish market works, right? So the logic of the SMT basically implies that at one point, price will not make a higher high and the algo will consider it as a break of structure. No, it's going to consider it as a liquidity sweep, okay? Now, you don't need this low to be broken to the downside in order to consider that this is a liquidity sweep, right? What you need, however, from an SMT or from a divergence point of view, is that you need the indicator, in this case silver, right, to tell you that there is some sort of weakness going on in the market, right? So we had a strong bullish market so far, but right now it is expected for that market to be weak, okay? So it's not strong anymore, it's going to become weak, right? So what does it mean? Now you're thinking, okay, but price is still making a higher high. How is that a weak market? Okay, well, since it's making a higher high, well, it's a weak market if the indicator, in this case silver, is unable to create a higher high. Okay, so in this case, the indicator is telling you that gold going above the previous high in here is actually in an overbought condition. Okay, and it's not just the normal thing that gold does in a bullish market, which is just break structures to the upside. It's telling you that this is an overbought condition and that silver is unable to push higher, right? So in this case, what we want to see is that, sorry, one of you is unmuted. If you guys could please check if all of you are muted and mute yourself, okay? And only unmute when you have questions. Okay, so in this case, gold going above this high over here, while silver during the same time. So this is very, very important. We don't want silver to stop making a higher high at a random hour, okay? As gold goes above here, okay, so this push to the upside, let's say it started at, I don't know, 7:30 a.m. New York, and it till here it's like 7:45. During that same time, from 7:30 to 7:45, silver is also making a push to the upside. Okay, it's still going up, but it's not going higher. Okay, like gold did. Okay, so during the same time as gold goes up and supposedly it's breaking a new structure to the upside, silver is unable to do that. So this is the break in correlation. Okay, this is the crack in correlation, some people call it on social media. So in this case, what we want to see, the logic behind this type of divergence, this type of SMT, and the link that it has with where should the fair value gap form, whether it is going to be on the first bearish leg or on the second bearish leg. Now you're going to say, Alex, which is the first leg, which is the second leg? Well, every SMT is going to be created of two swing highs. Okay, in this case, we're going to have swing high number 1 and the swing high number 2. How are these two swing highs being created? Every swing high is created by a leg that goes up and then a leg that goes down. Okay, that's how that peak is being created. Price goes up and then goes down. So therefore, that peak is being formed, right? And then we have another leg to the upside and then a leg to the downside. So as a consequence of the leg up and then the leg down, we have the second swing high forming. So these two highs in here, these are the highs that are in SMT divergence with silver. So therefore, what we want to do is we want to look at the bearish part of these two swing highs. Okay, so this is the first bearish leg and this is the second bearish leg. So in case we're looking at a bearish reversal divergence, the logic is the following. Gold takes buy-side liquidity from that high, and it will use it to pair it with smart money short orders. Therefore, the indication that that buy side is being used to pair with smart money short orders is the fact that on this second leg, we're going to have a bearish FVG forming. So if we're looking at a reversal divergence, always, in order for it to be logic, in order for it to make sense, we always want the fair value gap to be located on the second leg, or if you want, after the liquidity was swept by gold. Okay, this is the liquidity, this is the sweep, the push to the upside that goes above it sweeps liquidity, but you don't know that it's a liquidity sweep yet. Okay, you will know it was a liquidity sweep when two things happen. First, you see that silver is unable to go higher. Okay, and second, you will have the bearish fair value gap being formed by gold on the second bearish price leg. Okay, so far so good. Do you have any questions so far?
Yes, Alex, hi. I have
Yes,
one question.
hello, please.
Do the swing highs have to happen in the same 5-minute candle in both gold and silver?
You mean if this should be precisely at the same hour as that one and this precisely at the same hour as that one?
Yes.
It's ideal when that happens, but it can have an error about 2-3 candles, maybe 4, okay? But you should not see that it's happening like, I don't know, we have the second price leg or whatever, the first, the second, it doesn't matter. You should not see a deviation if you want, more than 4 candles. So you can have, for example, gold being, I don't know, 745, okay? And maybe silver is going to be at, I don't know, 8 a.m., okay? 8:00. So that's 3 5-minute candles, okay? But it's ideal if they're going to happen both at exactly the same time, but not every time you're going to see it doing that, okay? The important part is in here, the fact that silver obviously cannot go higher, okay? Even though gold did go higher. And the second important part is that we're going to see gold creating the bearish fair value gap where it's supposed to create it, which is where on the second bearish price leg. Okay, so now think about it like this. This is basically telling us, okay, like I was saying earlier, that if gold is going, it's creating a higher high and silver is not, okay, usually what you're going to see happening in here, you're going to see that the SMT is going to be the first thing to happen, okay? So in this case, we're going to have gold going higher, okay? This is going to happen. You're not going to have the second push to the downside, right? You're not going to have it. You will not even know, or maybe in here, we're going to form like a swing high, which is a bullish candle, and then another candle, and then a candle that, you know, the 3-bar pattern, right? And you'll see this is a swing high, this is another swing high, and both of them like this is a higher high, okay? And then silver is going to do this, okay? Now, at this point, you don't know if silver will continue to go higher or not, okay? You don't know if this push to the upside will continue beyond silver's previous high or not, right? So because of this, you have to wait for the fair value gap. Okay, so we have first the SMT. It's obviously, okay, during 745, gold went higher with the 745 candle, and the 745 candle on silver did not go higher. So it's the same candle, or plus minus, I don't know, 2-3 candles, okay? Gold definitely went higher, but silver did not. Okay, so in this case, the SMT will be the first thing to appear on the chart, but your SMT is not yet valid, okay? Your SMT will be validated only if and only after gold will create the bearish fair value gap in here, okay? And like I said, price doesn't even have to break that low that is located between the two highs that are divergent, okay? You could just have gold doing this, and then you have a fair value gap in here, okay? And if silver created a swing high in here, which you can clearly see that right now it's a lower high, but gold made a higher high during the same time when silver didn't make a higher high, okay? And then you just wait for the fair value gap to appear, and that's where your SMT is confirmed, okay? Now, the next thing you got to do is just wait for price to tap the fair value gap, and then you already know you wait for one entry candle, which should be a 5-minute bearish candle, okay, which ideally should have like a, you know, a visible bearish body, okay? And the less rejection you have to the downside, the better. Well, so what I mean by this is if you're going to have a bearish candle, okay, it's okay if the top wick is big, but you don't want the bottom wick to be too big, okay? Okay, questions? Okay, no questions. Now, another thing with the reversal divergence is that what you want to make sure, what you want to do is make sure that you're not taking like a bearish reversal divergence. You're not considering a bearish, because think about it like this. Something can reverse to bearish, okay? Something can reverse to the downside only if it's bullish. So you cannot have, for example, a bearish market, okay? And then gold will do this, and silver will not. So silver is also bearish, okay? And silver will do this. So you're going to have this on gold, right? And then you're going to have this on silver, okay? In this case, this gold making a higher high, silver making a lower high, it's the exact same thing as we have in here, okay? But so it's still a bearish reversal divergence. The thing is that gold is already bearish. You can see that the trend is bearish. You can see that price has been moving bearish, okay, for quite some time. Therefore, this trade to be taken on gold would not really make sense. It would make sense, however, if you would use gold in this case as the indicator, and you would use silver as your traded pair, because in this case, the traded pair making a lower high, while the indicator would make a higher high, would mean a bearish continuation divergence, okay? Something which is bearish cannot reverse bearish. Only something which is bullish can reverse bearish. Make sense? Okay. So Vasilis has a question. From now on, shall we use the seminar as the guideline or also what has been stated in the Telegram so far? I'm just going to state the exact same things that I've been stating in the Telegram. This is just me telling you what I told you in the Telegram, but saying it verbally, not in writing, and you know, also showing you. So it's the same thing. Okay, now, questions before we move on to the next type of SMT?
Hi, Alex. It's Ibs. You're right.
Hey.
Just a quick one. You see the way that that's formatted like that in your bullish direction, right? Where you've got the silver at the bottom, which is your indicator, and the gold at the top. Will it always be formatted like that? So, for instance, would you always expect the SMT to go on the gold to go like pointing upwards and the silver to be pointing downwards? Could it not be the opposite way, or would it only have to be formatted like that?
Okay, if it's going to be the opposite way, it's going to be like this, because we also had something like this the previous days, but it's not going to be a reversal. Like something happening like this will indicate a reversal. Now, guys, what does a reversal mean? A reversal means that if this price is going up, it's creating higher highs and higher lows, okay? In other words, we have this as a broken structure. This is a respected market structure, the low, okay? The high is a broken structure, the low is a respected market structure. So when we're going to have what does a respected market structure mean? It means that the previous higher low that has been formed, okay, the last higher low that the market created, it's a protected level. In other words, price should not go there, okay? That's why it's a protected level, because we're not expecting price to go there. So at any point, if you're going to look for a long, right, your stop loss can or should optimally be under that level, because we're not expecting that level to be broken. Why? Because it's a higher low, and in bullish markets, the lows are not broken, okay? That's the logic. So if we're going to have a bearish reversal divergence, what that means is the following. It means that if gold will go higher, okay, now there is a very, very big likelihood that if this is a reverse, or not if, but since this is a bearish reversal divergence, there is a very big likelihood that this is going to be our drawn liquidity, or even this one. So the type of SMT that we're going to have, okay, in this case, a bearish reversal divergence, will indicate that the following move that's going to happen, which is to the downside. So price goes above that high, silver doesn't go above that high. So there you go. We have the SMT, okay? And now we're waiting for the SMT to be confirmed by the bearish fair value gap, and gold forms a bearish fair value gap in here. Gold goes up into it. So now it's rejecting. You get your entry candle. You click the sell button, okay? And at this point, you need to have a drawn liquidity in mind. Okay, I know where I'm entering. I know where I'm putting my stop loss, but what's my target? Where is price likely to be drawn to? So because this is a bearish reversal divergence, okay, it means that price will not respect what it should respect in a bullish market, which is what? Lows. It's not going to respect the lows anymore. Okay, so there's a very big likelihood that the previous higher low that has been formed is going to be a drawn liquidity. Okay, now There's also the other situation in which this divergence is going to happen like the following. So you're going to have gold going higher, okay, right? Silver is not going to go higher. So there you go. You have the divergence, okay? So gold created a higher high. No, sorry. The other way around. Gold doesn't make a higher high, okay? However, silver does make a higher high, okay? Now, in this case, technically speaking, this would be a bearish reversal divergence for silver, okay? So in other words, silver in here is the traded pair and gold is acting as an indicator. But we want to trade gold. We don't want to trade silver, okay? So how can we use this in our advantage? Well, think about it like this. In this case, this divergence, if you're going to look at the divergence matrix, that image that I sent so many times in the chat, that is going to signal a bearish continuation, okay? So this is a type of divergence that indicates bearish continuation. But now think about it like this. I can clearly see that gold is bullish. How can it continue to go bearish since it's bullish? So it doesn't make sense. But still, I can see the fact that I have a bearish fair value gap on the first price leg, okay? So I have the first high, which is divergent, and then the second high, which is divergent, okay? So price goes up, okay, and then goes down, making a fair value gap, a bearish fair value gap. As gold will retrace up into the fair value gap without going higher, therefore it's going to make a lower high, okay? Silver, during that push to the upside that gold is going up into the fair value gap, silver will create a higher high. Okay, so you have this high, which is, let's say, 745, right? Let's say this high is also 745 on gold. So 745 gold, 745 silver. Okay, and then let's say you have, I don't know, 840 on gold in here, and you have 840 on silver in here. Okay, so in this case, 745 went up and then went sharply to the downside, creating a fair value gap. And then as price goes up only till the fair value gap, during that same time, silver goes up and it makes a higher high. But now gold is stuck in the fair value gap. Okay, so now the first thing that you had was the fair value gap. Okay, and then in order for you to consider the fair value gap to be valid, to be what? Think about it like this. It's unusual for a bearish fair value gap to happen, to appear in a bullish market. Why? Because fair value gaps are imbalances. It is likely for a bullish market to create bullish imbalances because, that's why it's a bullish market, okay? Because the imbalances usually happen to the upside. And it is unusual for a bearish imbalance to occur in a bullish market. Why? Because, that's why it's a bullish market, okay? Because bearish imbalances do not happen. When price goes down in a bullish market, it goes in a balanced way, because if this is the imbalance, then the rebalance will occur in a balanced way, okay? Right? There's just simply no other way for me to put it, right? However, if we're going to see price in a bullish market creating a bearish fair value gap, and as it goes up into it to rebalance it, now you have to be a little bit skeptical. Okay, what is a bearish fair value gap doing in a bullish market? It doesn't make sense, right? So at this point, you have to think of it not from a reversal perspective, because that's not, gold making a lower high and silver making a higher high. This is a bearish continuation divergence for gold, okay? So, but it's happening in a bullish market, so it doesn't make sense. How can something which is bullish continue to go bearish? It doesn't make sense, right? But the divergence is there. And you see that you had a bearish fair value gap here. Gold goes up into it, creating a lower high. And as gold goes up, silver goes higher and creates a higher high. So this is the divergence. So you have to make sense of it. A bearish continuation divergence in a bullish market, because you want to trade gold. So how do you do that? In this case, this divergence is not showing you that gold will continue to push lower. No, because it's in a bullish market. It's a bullish trend. It cannot continue to go lower. it can either, it can't either reverse, because this is not a bearish reversal divergence, it's a bearish continuation divergence. So in this case, the interpretation that you must give to this type of divergence is the following. So gold has been going up for quite some time, and now a pullback will start. Okay? So if a pullback will start, it means that the drawn liquidity is likely not to be a previous higher low. Okay, it's likely to be a higher time frame fair value gap. Does it make sense? Guys, does it make sense?
Yep, yep, yep.
Yeah? Okay. So you have to interpret these SMTs and where is the fair value gap forming, on the first leg or on the second leg? And also, what type of market am I in? I'm in a bullish market and I have a bearish continuation divergence. How can I make sense of it? Well, you can make sense of it if you look at it not as a bearish continuation, because for the 100th time, I'm going to repeat this. Something which is bullish cannot continue to go bearish. It can only continue to go bullish, okay? But it cannot continue to go bearish. But I do see that in a bullish market, I have a bearish continuation divergence. So how am I going to make it make sense? Very simple. Gold has been going up for quite some time, so it is a big likelihood that a pullback is going to start. Can I take advantage of it? And the answer, of course, is yes. But now, like I said, your drawn liquidity is not going to be a swing low. It's not going to be a previously considered protected level. Okay? Like it would be in here, for example. Well, I have the, let's draw this again. So let's say I would have gold, bullish, right? The lows are protected levels, okay? Then I have gold going up, okay? And then it creates the fair value gap. What's the protected level in this case? It's not that one, because that's just going to be a minor low, okay? So in this case, this is going to be the protected level, okay? Just think of it like this. Goes up, then it goes down, makes the pullback, goes up, goes down, makes the pullback, goes up, right? And then goes a little higher, and then boom, it makes the fair value gap, okay? So now, gold went up, but silver didn't go higher, right? So we have a higher high on gold and a lower high on silver, and we have the fair value gap on the second leg on gold. So in this case, where is my drawn liquidity? Boom, here. Okay, why? Because this is a reversal divergence. Something which goes up is likely to reverse. What is a reversal? What does it mean? It doesn't mean that price will only pull back to the 70 or under the equilibrium level of the last bullish leg from that low to this high. It doesn't mean only that. It means that it's likely to want to break a low. A protected level is going to be broken. Why? Because they want to take out early buyers or whatever they want to do. You don't give a fuck what they want to do, okay? You just don't care why they're doing it. You only want to see when they're doing it, okay? So, and the other scenario is we have gold, right? In this case, not going higher, okay? But it created a fair value gap in here, right? So now you're thinking, so gold is not going higher, but silver is going higher, right? So in this case, this is just an indication of weakness in the market, right? So if on this push, last push to the upside, you have like a fair value gap over here, then that's likely to be your drawn liquidity. And only there. You can only get like a, if you want, like a guaranteed paycheck only till that fair value gap. Okay? So it's like, okay, so if the market is not going to reverse, therefore break a previously considered protected low, okay? Because it's not making a reversal divergence in order to make this previously considered protected level to make it a drawn liquidity, okay? No, what it's doing is doing this. It's going up. It's in a bullish market, a bullish trend, right? Then it makes pullback, then it goes up, then it goes down, then it goes up again, and then it seems like it's going up, right? But in here, you already had the fair value gap created. And as it goes up into it, okay, silver will go higher. So you're going to have a higher high on silver and a lower high on gold. So in this case, like I said, this would be a bearish continuation divergence. But how the fuck can something which is bullish continue to be bearish? Very simple, okay? This is a bearish imbalance, price repricing into that imbalance as silver goes higher, creates a higher high. And silver should start to reject from there as soon as gold will also start to reject from the fair value gap. And at that point, your drawn liquidity is guaranteed, or yeah, like your bearish move is only guaranteed, so to speak, to go till the midpoint of the last bullish price leg. So you would look, so this is the midpoint, and a little beyond it, under it, there's like a fair value gap or something like that. Okay, so in this case, this would be like a retracement. This bearish move that's occurring is just a retracement. Okay, makes sense? Okay, let's see, because in the meantime, some of you wrote in the Zoom chat. So Ryan, so using fair value gap on the first leg is only for trend continuation SMT trades. So it's a continuation, but only it can, like I said, Ryan, it can also signal a weakness, okay? It's not actually a reversal, okay? But in this case, like I was explaining, if the market is bullish, okay, and you're gonna have the fair value gap on the first leg, and you're gonna have on gold a lower high, but silver will make a higher high. As gold goes up in the fair value gap, silver will create a higher high. In this case, this is a continuation divergence. But again, if the market is bullish, it cannot continue bearish. Okay, so it means that this imbalance is signaling that fair value gap, which occurs before the SMT. Okay, this fair value gap will only be confirmed as a valid resistance level, if you want. Okay, only after we have the SMT. Okay, and this will signal not a bearish continuation because it's bullish, it can't continue bearish, but it will signal a pullback. Okay, and you can make yourself an idea around where would it want to go? Where should I consider getting out with all my position? Okay. Okay, Matt is asking, do we need to factor in POIs, for example, Asia high, low, or previous days high, low, etc.? I'm telling you that the most powerful setups are going to happen at POIs. Those are going to be the moves that are going to move the most. Okay? Okay. So, without, you're welcome, Matt. So, without really wanting to do it now, we've also talked about the continuation divergence, right? So we had the bearish reversal divergence, okay? And then we're still going to talk about the bearish continuation divergence. So we got bearish reversal divergence and bearish continuation divergence. So for the continuation divergence, it could happen in two ways: to make sense for it to continue bearish, or to not make sense for it to continue bearish because the market is bullish, but to make sense that a pullback is starting. Okay, so again, on top, we're going to consider that we have gold, and on the bottom, we're going to consider that we have silver, right? So gold is bullish, right, in a bullish market, and it doesn't make a higher high. Okay, silver is also bullish, and it makes a higher high. Okay, so in this case, this is the first swing of the divergence. This is the second. Okay, and for silver, we have this as the first swing of the divergence. So this is the second. Okay, so in this case, like I said, technically, this is a bearish continuation divergence. Okay, but something which is bullish cannot continue bearish. Therefore, in this case, we want the fair value gap to be located on the first price leg. And as gold goes up into the fair value gap, with the purpose to only rebalance the fair value gap and not attack that high, okay, silver will attack that high. right? And that's how you got the fair value gap first, because it's being created on this price leg. So price goes up, makes a pullback, goes up, makes a pullback, right? Goes up, and then boom, it makes a fair value gap. So you don't just get a pullback like that, okay, that starts in a balanced way. You get a drop, okay, with a bearish imbalance. So in this case, the fair value gap is the one that forms, okay? During the same time, silver is doing just the same thing. Goes up, makes a pullback, goes up, makes a pullback, okay? And gold goes up into the fair value gap, but silver goes higher, okay? So in this case, this type of divergence, which is bearish continuation in a bullish market, would basically signal weakness from the side of gold. Okay, now this means that later on, after whatever fair value gap that's going to be in here will be reached, and you would have gotten your TP or your drawn liquidity, which is only going to be a fair value gap and not a protected low. Okay, at that point, you should expect, if you're going to get like a bullish entry confirmation under the form of, I don't know, another SMT M5 model or whatever, you're in a POI for a RBV setup and you get an entry confirmation, you should expect your drawn liquidity to be this. Why? Because this thing that happened here was a weakness sign, a sign of weakness from the part of gold, okay? But because it's not going down and breaking a low, which was a previously protected structure, and as soon as it reaches into a lower, higher time frame, into a higher time frame fair value gap, it's going to reject from there, right? Giving you another bullish. Now, this time it's going to give you a bullish entry confirmation. At that point, you should expect your drawn liquidity to be that high because it's a very big likelihood that the market will continue to do what it's supposed to do when it's bullish, which is what? Break structure to the upside, okay? Because it went down, it rebalanced whatever fair value gap it had around here. It gave you signs that it wants to go down to rebalance that and only rebalance without necessarily wanting to break a low, okay? And then if it's going to show signs of strength again, you should expect a new structure to the upside to be broken, okay? So this would be the type of bearish continuation divergence, okay, that would happen in a bullish market. That would not really make sense for something which is bullish to continue bearish. However, you can still make sense of it, considering that gold is going to have a pullback, okay? So yeah, it's going down, it's dropping heavily because it has the purpose to rebalance this higher time frame busy, okay? Now, the other type of bearish continuation divergence would obviously happen in a bearish market, okay? So we're in a bearish market, highs creates lower highs and lower lows, okay, on gold. It does the same thing on silver, it's creating lower highs and lower lows, okay? Nothing unusual till here, right? What's going to happen is the following, and we can have in here. We're going to have a bearish fair value gap around here, okay? And then gold goes up into it, right? And at that point, it's going to start to reject from it. As gold goes up in here with this push, right? Silver is going to go above a high, okay? So in this case, we're going to have gold creating a lower high and silver creating a higher high, right? So in this case, this is basically telling us that silver is in an overbought condition and that gold only went up in here to rebalance that fair value gap, and now it's likely to continue to push lower. And this makes sense from a bearish continuation divergence because you're already bearish. Okay, so the trend is already bearish. Okay, Elia is asking, are these protected lows / highs independent from weekly, daily, intraday structures? They can or cannot. I cannot say that, yeah, they're going to be just in, weekly, only look at weekly highs and lows, daily highs and lows, and kills on highs and lows, and those are the protected ones. No, not really. Okay, you're usually going to see, like, think about it like this. how to spot like the actual market structure in a classic way if you wouldn't be using time as well, as in, to consider that a daily structure is the highest high and the lowest low created within a day. So you're also using the time factor for this. If you don't want to use the time factor, it would simply be just looking at market goes up, goes down, goes up, goes down. In this case, we have a high and then we have a higher high. So the protected structure in this case is the lowest low between the two highs. Okay, and these would be just intermediary lows. So if we were to consider gold, for example, and let's go to the 15 minutes. I just want to see a little more price action. Okay, so if we were to consider this, okay, you have to really zoom out because you want to be able to see like big price swings. Okay, so in this case, I have this high. Okay, which high made a higher high? Which went higher than this? Which one is higher than this? It's in here. Okay, so the lowest low between these two highs, which one is it? It's that. Okay, so technically speaking, only if that low would be broken, I would have a break in market structure, like really a break in market structure. Okay, and then I have this high. Okay, now where is price going to go higher than that? Where? So I had this, okay, and price is going higher than that in here, okay, in here. Is it establishing like a swing high? Okay, yes, it did. Here it is. So I had that one, and when price went higher than that, it was here, okay? So between these two highs, the time, all this time, all that time, which low is the lowest? I think it's this one, okay, there. Right? So that's the market structure. That's the protected low. That's why you see price not going under there. But of course, it didn't do that. Okay, it didn't go down there prior to going above that high. So, levels become protected. So this level became protected only after that high was broken. Okay, which happened here, which was quite a few days after that. Okay, and I think that if we go to the 1 hour, we're even going to have a much better view of this, right? For example, you see here, that high, okay? Price went higher around here, okay? This means that only after this high was broken in here, only after that, this low became protected, okay? So now, if you're going to have price dropping heavily, your drawn liquidity is likely to not go till here. And if it goes till there, then it cancels your entire idea of this push to the downside being only a pullback or whatever, okay? Your drawn liquidity can be here, but it's likely not to go down there. And if it goes there, that's your actual ICT breaker, okay? Like the real breaker, okay? If we go to the daily, for example. Okay, so basically, you're just looking at swing points. Okay, let's just take a random piece of price action. Okay, so we've got this high. Okay, when did price go above it? Here, right? So after price goes above it, this low becomes protected. Okay, and if you want to take it like more granular, if you want, right? You have so this is where like a reversal happened or something like this. So I have this high, okay, and then price went above it in here. Between these two highs, which is the lowest low? That one. So this is a protected level, okay? So basically this means that whatever buy side price would take from above that high when it goes up in here and then it starts to drop heavily, it's likely that your drawn liquidity will not be there. It's going to be something in between, okay? Then we have this high, okay? And where is it broken? It's broken here by that high, right? So what's the lowest low in between these two? It's that one. Okay, so it's a big likelihood that that low, no matter how big the drop is going to be after price goes above this high, there's a very big likelihood that this low will keep being protected. Okay, then we have this high. And where does price go above it? In here, okay? Now in here, you can see that price only poked above it, right? Now I've seen people considering that if it just pokes above it, it's likely for this low in between, which at this point is a protected level. Why? Because this high was broken by this high. Okay, so you have a high and then you have a higher high, right? So when is the higher high considered to have broken a market structure? Obviously, when it broke a market structure. And that's when the low in between these two becomes a protected level, right? So you have the high, price goes above it in here. And now the lowest low in between these two is the protected market structure, okay? Now, what happened in here? What do we have in here? It would have been really, really nice to see if in here we had a reversal divergence. So we have a high and then we have another high. Okay, so we had two higher highs. This at this point is a protected level. But you see what happens in here? You see, price attempts to go higher, but it cannot go higher, right? So now you have to think of it like this. Okay, so I'm in a bullish market, but I'm seeing gold creating a lower high. If, let's say, silver had created a higher high, okay, so gold made a lower high and silver made a higher high, okay, this would have meant that we're looking at a bearish continuation divergence, but the market is bullish. It doesn't make sense for it to continue bearish. So how can I make sense of price going higher here, but not higher in here? Now, I want you to look at how that candle formed. It's pretty big, isn't it? Big bearish candle, right? After bullish momentum. So there's a big chance that during that candle on the lower time frames, we had some sort of fair value gap forming. So we had the first push to the upside, creating the fair value gap. Then price goes up to rebalance the fair value gap and then goes lower. So now think of it like this. If this is showing weakness, because it cannot show a reversal, because it's not a reversal divergence, it's a bearish continuation divergence. But something which is bullish can't continue bearish. But still, I see the divergence and I have to make some sense of it. So if it cannot continue bearish because it's bullish, okay, then it means that it's showing some weakness. And if it's showing some weakness, it means that this push to the downside is starting, has the purpose of going down. Why? To rebalance some old imbalance that occurred on the last push to the upside. Okay, and it's not such a big likelihood that that low is going to be taken out. But now you also have to think of the following. Okay, we're on a daily chart in here. Okay, and I don't really see any bullish imbalance on this push to the upside. Okay, and again, a bullish imbalance that it's sitting under the equilibrium level of this move, because we can, I'm looking for the fib, where are you? You can see that I'm not using, okay, let's just take a rectangle. So from that low, okay, to this high, right? The midpoint is here, okay? The midpoint is that dotted line. So if this is the midpoint, right? It means that if this would be a weakness indication, okay? The fact that, let's say gold did not make a higher high, but let's say silver did, and gold stopped into whatever imbalance would have occurred during that bearish day, okay? Then it means that if I don't have a bullish fair value gap under the equilibrium of the last bullish price leg, okay, then it's a big likelihood that price will actually want to attack that low. And in this case, it's not going to be a break of structure to the downside. Therefore, it was a reversal here, because that was not a reversal divergence. It was a weakness divergence. Okay, it was a divergence that indicated temporary weakness on gold. So if the trend is bullish, but you see temporary weakness coming in, what does it mean? It means that it wants to continue to go higher, but in order to do so, it has to take out some sell-side liquidity so that it can then use it to pair it with smart money long orders. Does it make sense? So you see, you have to use all this into a very logical context, because otherwise it's not going to work, or it's going to work less often than it should, and you're not exactly going to know what you're doing wrong. But the thing that you're doing wrong has nothing to do with the charts. It actually, Marco, stop drawing on the screen. So it has nothing to do with the charts. It has to do with the way in which you're interpreting things, because you're not putting everything in a context. Do you guys remember the thousands of times when ICT repeated in his videos? Like, I think that all his videos say, in all his videos, he says the following thing. I'm curious if you guys know what I'm about to say. Or if you're already thinking about it. He says what? The narrative. What the fuck is the narrative? What the fuck is ICT saying when he says, but it has to follow a narrative? This is the fucking narrative that it has to follow. This is it. Okay? You cannot just take every concept. Oh, I see a fair value gap in an SMT. Yeah, let's buy, let's sell. It will not work if it's not following the narrative. And the narrative has to do with, what type of market am I in? Bullish or bearish? Okay, I'm in a bullish market. Okay, this thing is ticked. So I've already verified. What type of market am I in? Bullish. Okay, what type of divergence am I seeing? I'm seeing a bearish continuation divergence. What the fuck? The market is bullish, but the SMT is telling me that it's going to continue to go bearish? No, it should show me that it's reversing bearish, not that it continues. Okay, so if it's showing me that it continues, it means that it's actually not reversing for good, but it's only going to show temporary weakness. Does it make sense? Okay, so in this case, the divergence in here, which was a temporary weakness divergence, is the one that tells us that when gold is going to go under that low, which previously was seen as a protected level, that's not going to act as a broken market structure, but it's actually going to act as a sell-side liquidity sweep. And then guess what's going to happen? Relatively equal highs are going to be attacked. Of course, for me, it's very easy to show all of this to you in hindsight, because basically this is what I'm doing. Okay, but you can see how, even if I would be saying all of this in hindsight, if there would be a person who would know the basics of the underlying conditions that have to be met in order for a market to be bullish, which is what creates higher highs and higher lows. Okay, when does it change bearish? When the lowest low in between the last two higher highs is broken to the downside, right? So at that point, this person could tell me, yeah, but Alex, this was a break in market structure. And I'm sure that based on our RBV method of identifying the bias, this was some sort of weekly low being broken to the downside. And we would say, well, our weekly is bearish, right? Well, sometimes, yes. Actually, most of the times, yes. But at the same time, that could also act as a sell-side liquidity sweep. Now, I'm really, really curious to know if we had a divergence here. So you guys know what I'm going to do. I'm going to take this out and I'm going to mark this highs. No, we had these two. Okay, so these were what? 22nd of October and the 28th of October in 2021. So let's check silver, because I swear to God, I am so curious about this to know if we had a divergence on silver. So on the right side, we have silver. Let's go to the daily. And it's 2021, right? 2021 in October. October 2021, July, October. So which was that? So So we got October 21 and October 28. Okay, so we have on silver, it's this high into this high. Okay, here's what happened. Okay, so in this case, here's what occurred, but without having the actual SMT. Okay, we had definitely bullish market on silver, right? And what happened here is we had this high, okay, and then silver created come on, this thing, that fair value gap. Okay, so we had silver creating this high just as gold did, right? But in this case, gold did not show us a bearish fair value gap here. You see, however, silver did. You guys see? So when silver went up into the fair value gap, okay, gold went above October 26. Okay, so the actual divergence was here. There it is. And let's go to the 4 hour and see. I've lost it. Oh, shit. Okay, I think I know how to go where it was. I should go into my object tree, I think. Oh, shoot. How do I know which is the line? Okay, I don't. You guys can see that I have no idea how to use TradingView except for the basics. So just bear with me. So that was October 21st, 2021. April, February. Okay, here it is. Okay, and now let's do the same for gold. Okay, so you can see where the divergence was. Okay, this candle on October 26th at 1 a.m. my time zone with October 28th at 1 p.m. and it was, wait, it was here. There. Okay, so this was the divergence, right? And we can see silver creating that imbalance on the first leg of our divergence. Okay, so this basically indicated a bearish continuation on silver. In other words, weakness on silver, because, well, yeah, we're on the 4 hour chart, so you could consider that for a few days in here, I don't know, 5 days or so, silver was already bearish, right? But in this case, we had a reversal divergence on gold. Okay, because if you want to trade gold, right? If you want to trade gold, you have to consider the divergence from the point of view of gold being the pair that you're trading and silver being your indicator. Okay, so in this case, gold goes above there, silver doesn't. Silver stays in the fair value gap, right? So the market is showing us two things at this point. The first thing that it's showing us is that this is just a liquidity sweep on gold. The second thing that it's showing us is that silver is going to go through a temporary weakness period, right? So now seeing that in fact this was a reversal divergence on gold, it does make sense that this low was attacked and that was the actual drawn liquidity. Exactly what I told you earlier. How do you make a difference between, or what's the difference between gold making a higher high and silver not? So this is a reversal divergence, right? In a bullish market, or still in a bullish market, gold not making a higher high, but silver making a higher high. So this would be from gold's perspective, this would be a bearish continuation divergence. But again, since we're in a bullish market, then this bearish continuation does not mean that price will break a previously protected level. It means that what gold will do will only rebalance whatever fair value gap we would have to the left side of the chart. Okay. However, in this case, since we had the reversal divergence, then now it makes sense why that low was attacked, because previously this was seen as a protected level. Okay. And this was a totally randomly selected example in the chart. I swear to God, I have no idea what would have happened like this. Okay, let's still see some questions that you guys are posting. So Vasilis, do we consider cases where the FVG emerges after the SMT legs? For example, no fair value gap inside the legs. So Vasilis, you can unmute yourself because I have to understand your question. So you're saying you don't have a fair value gap on none of the two SMT legs?
Yes. Yes.
Okay, so it's impossible, right? And it's impossible. What I'm saying is I'm thinking that you consider that there is no fair value gap on either of the two legs because you want the fair value gap to occur immediately. But sometimes the fair value gap is not going to occur immediately. Let's say you're going to have, I don't know, what case do you want us to talk about? The one where we need to have the fair value gap on the first leg or on the second? Or it doesn't matter. I don't know.
Doesn't matter.
Doesn't matter. Okay, so let's say we have the first leg of the SMT, okay? And then we have the second leg of the SMT, right? And from here, price is not going to form a fair value gap. It's just going to drop down in a balanced way, right? Now, because the market doesn't move in straight lines, right? Neither this push to the upside moved in a straight line. It moved like that in small little waves, okay? Also, did this push to the downside? It happened in small little waves. Also, this push to the upside is happening in small little waves. But for the sake of clarity, we're just drawing them as straight lines, okay? But like I said, the market usually, not usually, but always, it moves in, small little waves, right? So in here, after gold goes up, right? And let's say silver doesn't go up, okay? Now you're waiting for this SMT to be confirmed by a fair value gap. And what we're used to do is we're used to usually wait for this fair value gaps or to see them occur immediately after the high was created, right? Or within the next few candles. But not every time it's going to happen like this. So you're considering this the first leg and you're considering this the second leg, and you have the SMT, but on the second leg you have no fair value gap. Chances are that your fair value gap is going to form on the same leg, but a little later, okay? It doesn't mean if it forms here and not there, okay, close to the top, but pretty far away from the top, it doesn't mean that it's still not valid. It's still valid and it's still on the first price leg. Does it make sense, Vasilis?
Yeah, that is what I was asking. If it forms a bit lower on the second leg.
If it forms a bit lower, you know what I've usually noticed, and I know that also ICT confirmed in a video of older video, but I don't know exactly tell you in which one. So he said something like this, that there's going to be times, I don't remember exactly in which conditions, but now it makes sense, that when this low is going to be broken to the downside, that's going to be your breaker, and the market is simply not going to go above it. It's just going to kiss it, and then it's just going to drop heavily from there. So therefore, you're not expecting this entire portion of price action to be rebalanced. You're not waiting for a pullback above equilibrium of this leg, because you're not going to get one, right? So in these cases, let's say that you have the divergence, and from here till very close to that low, you don't have any fair value gap because price just goes down in a balanced way, okay? Without leaving any fair value gaps behind. So as it gets closer to this low, now you're going to see the fair value gap that forms. Okay, and then usually price is just going to rebalance that fair value gap, only kiss that level, and then continue to go down. Okay, so if the fair value gap doesn't form very close to the top, to the second high of your SMT, that's still fine. It can also form later. Okay, it's still valid. Okay. Elia, are these protected? Oh, okay. So, oh, Vasily, sorry, you asked the question before Elia. I didn't see it. Okay, now, Elia, again, but you do it at the smaller 5-minute time frame, right? Elia, unmute yourself and
Yeah.
clarify for me what is your actual question.
You showed the highs and lows and the protected structures,
Yes.
but you showed it on a daily time frame, and I think like
Okay.
for you to trade that, you in the 5 minutes charts, you do it there, right? Also with the highs and lows and stuff.
Absolutely. Absolutely. Yeah. Yeah.
Okay.
Okay.
you.
So if you would just ignore the fact that in here we're on a daily chart, just ignore the time frame. Okay. Maybe you would have this on the 5-minute. Okay. If you would have this on the 5-minute, then this would be your high, and then price went above it in here, right? So now that's your protected low. But something happens in between, and now this low is not protected anymore. It becomes a drawn liquidity. It's not protected anymore, right? Okay. Okay, this was a very cool example, honestly. This thing that happened here, really, really cool example, because it just, once again, it confirmed this theory. Not this theory, because it's not just a theory, because it's a theory only if you don't see it in action, if you don't have proof of it working. But that's actually, this is the narrative, I think, that ICT is just talking about. Okay, E. I don't know who is E, but he or she has a question. So internet keep cutting out. Okay, no, that's okay. Vasilis, SMTs that are the result of internal liquidity sweeps, not. Yes, they are to be considered. Okay, so Vasilis is asking if we can consider liquidity sweeps that are not kill zones, highs, lows, daily highs, lows, weekly highs, lows, if we would consider those. Yes, you would still consider them, but it really is important. What do you understand through internal liquidity sweep? Like, or should I say minor, not necessarily internal. Like, for example, if we go right now on, let's go to the 5 minutes. Okay, like I haven't looked at gold more than, I think, I don't know, 10 minutes before I actually started this conversation with you guys. I should have something which says remove drawings. Okay, so we're gonna remove drawings from here, from gold. Okay, and also let's look at silver. And we're gonna try to analyze the two of them together. Okay. Okay, so at this point, what I would consider that internal liquidity is, for example, on gold, based on the 5-minute chart, would be this smooth area in here. Okay, and this is not a kill zone low, a daily low, or weekly low, whatever. Okay, but to me, this is liquidity. Why? Because remember, you guys, when we talked about how to spot liquidity, and it's in two ways, that liquidity is visible on the chart, and it's really, really simple to spot it if you only do it like this. So you're going to have two types of liquidity: liquidity that is created immediately and liquidity that is created within time. So what I mean by this is the following: liquidity that is created immediately is that type of liquidity that is just going to sit above or under a very sharp high or low. So you're going to have price going up really fast and then come down really fast, and it's going to leave behind a swing high that's just going to be a wick or two. Okay, so that is immediate liquidity, right? Now, the other type of liquidity is going to be liquidity that has been created within time. So what does that mean? It means that you are going to see smooth edges. smooth area, like ICT says. Price is not showing for an extended period of time. Price isn't showing a clear willingness of going up or down. It's not, and it's creating a ceiling and it's creating a floor. And then as it's going to push away from that level, right? And then it's going to show you signs of weakness, then your liquidity is likely to be that smooth area that is located under that consolidation, okay? So in this case, today, based on how the chart looks like, the first minor liquidity that I would see would be around here. And I'm not going to say, well, it's going to be under that wick or it's going to be here, because it can be anywhere around or inside the rail, if you want, of this consolidation, okay? Like that. This, as soon as price touches this area, you're going to look at it as, okay, it reached liquidity. Anything could happen from here. Okay, if you have short setups, if you're into shorts, you should definitely consider taking some profits. And if price is going to show a quick rejection with SMT, with imbalance to the upside, whatever, then it's a clear sign that whatever liquidity it found here, it's using it to vary with smart money longs. Okay, now if I would zoom out a bit, the other liquidity area now that I would see obviously would be the low of London session. Okay, and then the low of the Asia session. This is time-based liquidity. It's not price-based liquidity. Because to be honest with you, price did not spend a lot of time in this area to accumulate there like it did in here, to consider it like liquidity that it takes time to build. Okay, but it didn't come down fast and then move away from it fast. Because if you look at it, it spent a few candles there, right? 1, 2, 3, 4, whatever. Okay, 20 minutes or so. Okay, but it's not enough to consider it like a liquidity that it's accumulated in time like this one, where you will really have just price meandering around, not doing absolutely anything. Okay, make sense? Okay, now, so we talked about reversal divergence, and we talked about continuation divergence and how to interpret the continuation divergence when it makes sense. So if you have a bearish continuation divergence in a bullish market and it doesn't make sense, then it would indicate weakness. So your drawn liquidity would be whatever higher time frame fair value gap you would see lower, okay? Or when you have a bearish market, okay, and you're having a bearish continuation divergence where gold doesn't go higher, but silver, still being in a bearish market, goes higher. So this is basically telling you that silver is overbought and that gold is just going to keep doing what it kept on doing till now, which is what? Break structures to the downside, respect highs. Okay? Now, then there's a third type of divergence. Actually, it's not a third type, but it's a second type of continuation divergence. Okay, again, bearish continuation divergence. Okay, so I have bearish continuation. Right, so how is this going to happen? So it's going to be a little different than the one that we just talked about, where I would have a bearish market, no, a bullish market, gold goes up, okay, and then it doesn't anymore, right? So it's showing weakness, okay, and then silver goes up and it's also going up, but then gold did not, and here you have the fair value gap in your first leg. So your drawn liquidity would be whatever fair value gap from around here. Okay, now the other that we just talked about would be in a bearish market, right? So bearish market, gold goes lower, makes a lower high, okay, and then makes a lower low, and gold, silver is also bearish, only that silver makes a higher high and then a lower high, and then a lower low, sorry. So in this case, this is a bearish continuation, still a bearish continuation divergence in a bearish market, which does make sense, okay? Now, the other type of bearish continuation divergence refers to the fact when we are usually going to see price creating equal highs or equal lows. Okay, so because we're talking about a bearish continuation, it's going to create equal highs. So we're going to have the market being bearish. Okay, gold is bearish, right? And then it's going to create relatively equal highs. Okay. And I'm not saying that it will slightly poke this high and then go down and we consider them relatively equal highs. No, what I'm saying is that from more like from a body perspective, if you want, you don't care if this high is going to be poked by a fraction of a pip or not. Okay. And then price in here is going to create some form of fair value gap. Okay. In this case, you're going to have the fair value gap being created in order for it to make sense around here after price is reaching at a high and it's finding resistance there. Okay. Silver, what silver is going to do in this case, silver is still bearish, is also bearish. Okay. Only that silver will not make an equal high. Silver will make a lower high. Okay. So your divergence here is gold creates equal highs, silver creates lower highs. Okay. So in this case, the fact that silver is unable to go close to this resistance level, like gold did, is telling you that this high will not be broken. And these usually is going to happen during those times and those examples when you're in a long trade and you're thinking, oh, it's going above there, it's going above Asia. Let's consider that this is Asia high or London high or whatever high, okay? And price will just go very, very, very close to it. And you're going to be so stubborn and you're not going to close your trade because you're thinking it needs to go 2 more pips above that high and then I will close my trade. And guess what? It reverses on you. How many times that happened? Did it happen to any of you? Because to me, it happened a lot. Okay, it didn't happen to any of you? Wow. Oh, okay. Yeah, many times. Yeah, that's why. Because if you're going to look at the correlated pair, okay. Oh, wow. Okay, yeah, just spill everything. Okay. So we have Ryan, we have Nimesh, we have Clarence, we have Trev, we have Duncan, we have Alfredo. Dirty market. Yeah, yeah, exactly. Dirty traders, more like. So this is what actually is going on, okay? That high will not be taken out if you see silver being pretty far away from that corresponding high that you're waiting gold to go above. Okay, let's say this is 745 and this is also 745 and let's say this is 920 whatever and this is also 920. Well, if you see 920 on gold being very, very close to 745 high and you're saying, well, I'm not going to take profit because it's 3 more bits till it reaches that high. And maybe it's also going to shoot above it an additional 5, 6, 7 pips. And then I can have more pips than I have now, 10 pips more than I have right now. So I'm not going to close, right? That's you thinking. But then you see silver being pretty far away from that high. Chances are gold will not go above that high. It's very big likelihood. And that's how equal highs are being created. And it doesn't necessarily mean that you're going to later on consider those highs as a draw on liquidity. Oh, look, gold created relatively equal highs during the London kill zone. So now during the New York kill zone, I will consider that my bias is bullish because it has to go above those highs. No, not all the time. As a matter of fact, more often than not, these highs are not going to be attacked immediately. You're not. You're just going to be left like that. And you have to think of it from a logic perspective. Why are they not usually going to be attacked during the same day or during the same session? And the reason is very simple. Because SMTs, smart money tool, this is where smart money are entering short positions. You're creating a resistance here. This is going to be that time when the resistance concept is going to work. okay? This is going to be that time. And the resistance concept, which was a formed resistance here, and now it's being respected. It's going to work. Okay, so this is the logic behind this type of bearish continuation. You're going to see gold creating equal highs. In other words, it has found resistance and it's not going to go above it. Okay, and silver is pretty far away from that high that gold just went very close to. So silver is really not going above that high, but gold is making an equal high, right? So that's the logic. We're forming resistance and it's going to be respected. Okay? Questions? Very clear, Ryan says. Okay, now let's analyze a bit today's market and today's price action and see exactly what's going on. So it doesn't make sense for me to move on to a higher time frame on gold and see what do we have to the left side of the chart, because we don't have anything. We are trading in uncharted territory. Okay, gold is just creating all-time highs, right? So there's pretty much nothing that we can do there. Now, silver, on the other hand, if we go to the daily chart on silver, we're going to see that it reached some high and it's not an all-time high, because if you're going to go to the monthly chart, you're going to see that the all-time high for silver was around $50. Okay, and now we're trading at about $32.50. So we're very far away from silver's all-time high. However, we have just went above an all high. Okay, so this could be a big deal or not, right? Now, think about it like this. And I think that I've told you guys this a few days in the chat. When you are trading gold and it's just creating all-time highs like crazy, okay? The idea of selling is going to be extremely discouraging. And if it's not, you're crazy, okay? I'm telling you by now, selling all-time highs, you're crazy. The normality of a, how should I say, of a profitable trader, of a healthy-minded trader, this person's normality should be to be scared, to sell all-time highs, okay? You should not think like the vast majority of the crowd thinking, well, it went up so much, it's got to come down. No, please do not be Karen, okay? Don't be like Karen thinking that everything is just like that, right? You should be scared to death to sell all-time highs. However, how can you take advantage of possibly a reversal? Or how could you take advantage of a possible deeper pullback? Because, you know, a pullback in a normal market condition is going to be, I don't know, 50% of the last range, and pip wise is going to be, I don't know, 50, 60 pips, whatever. Okay. But if you're trading at all-time highs, then there's a big likelihood that your pullbacks are going to be quite big. Like, for example, this pullback was 170 pips. Okay, now, yeah, I know that the last weeks, the average daily range or the average weekly range of gold has been insane, and 170 pips might seem nothing, but still, okay, that's quite a lot, a big of a move. So how can you take advantage of these larger pullbacks without necessarily being afraid that, well, I'm selling all-time highs. How can I be that crazy? Because if it just keeps creating all-time highs, what is likely to happen, to keep happening? Price will usually behave the same way as it did previously. So if you see that's why the RBV bias works. That's why identifying bias that way. So, well, if I would go right now on the 1 hour chart, okay, I don't have the daily highs and lows marked up, or even on the daily chart, okay? How many days has it been since price did not break a single daily low? 2, 4, 6, 7 days. Considering that gold is trading from Monday to Friday, we have 1 week and a half. Okay. So, and what happened when it broke 2 daily lows in here, or 3? Well, that was just a pullback. Okay. And the pullback, to be honest with you, the pullback wasn't even that big. The pullback wasn't even that big to consider that it went a little under the equilibrium. No, it did not. And actually started from here. It didn't even reach equilibrium. Okay, didn't even reach equilibrium. So in this case, how can you trade all-time highs without being crazy doing it and without being afraid to do it? You look at the correlated pair, okay? Because more often than not, the correlated pair is not going to be creating all-time highs, okay? Now, in this case, silver is not at an all-time high. However, it did reach this daily level, which is a pretty important level. Why? Because it's an old daily level. That's why. Okay, and because if you look at it on a daily chart, you're going to see that not only that it's pretty old, but it is also a high that was formed after price went up, and then it came down for quite a lot of time and a lot of pips. Okay, so now you got to think in terms of, okay, can the correlated pair tell me that there is incoming weakness on gold, and therefore I should not be afraid, or therefore I have reasons not to be afraid to sell all-time highs? So this is the only thing that could tell you whether you can sell all-time highs or not. And by the way, whenever you're selling all-time highs, you should definitely not expect price to go too deep. Okay? Like, let's just go back. Yesterday, we had such a lousy day, lousy price action day, but still with a lot of opportunities, okay? But you can see that mainly what happened, this was like accumulated liquidity, okay? Area where price spent quite some time accumulating, then it went up, and now it's acting as a drawn liquidity, okay? This was a sharp area, like a sharp, like a liquidity that it was formed fast. Price went sharply to the upside, and then it came sharply down. So now that's a liquidity area. This now it's a liquidity area. Why? Because price went down so fast, and then just as fast as it came down, it moved away from it. Okay, so this is now also a liquidity area, and these are liquidity areas that are not time-based. So again, they're not the low of a kill zone or of a day or of a week or whatever. I mean, this could be a daily low, and I actually think it's yesterday's low. Okay, but still, even if it wouldn't be, this would still be like a price liquidity area, simply because of the way it formed very fast. Okay, now if we were to consider that we're going to sell, okay, let's say we had whatever entry confirmation to sell this 170 pip move, you're not considering keeping your trade open till it breaks not even an intraday structure, because you're at all-time highs. There's a very small likelihood that every day price is going to break the low of the previous kill zone. Okay, maybe you're going to see this happening 1 or 2 days a week, but not every day of the week. Why? Because eventually those kill zone lows are going to be entry areas for smart money. So they're just simply not going to attack. They're simply just not going to go back to their entry levels. Okay, so that's when you should consider that your drawn liquidity is going to be minor liquidity areas. Okay, so the one I'm seeing right now was this thing over here, and you can see how it reacted once it reached around that area. And as I said, it doesn't have to come under that level, okay? Doesn't have to come under that level. Now, I'm curious to see if there has been some sort of SMT, nothing really. What I did notice a little earlier before we got into this call was this SMT in here that we had. So what is this signaling? Gold making a higher low and silver making a lower low in a bullish market. This signals bullish continuation. Okay, so just like the other one where we had like in a bearish market, gold create a lower high, and in a bearish market, silver creates a higher high, right? So the divergence at the highs, so it's indicating selling, okay? At the lows, a divergence will also indicate a possible incoming bullishness, okay? So in this case, gold making a higher low, right? It's basically telling you that it's just respecting the overall trending move, right? The overall market direction. And silver going lower in here, sweeping liquidity, is telling you that this is oversold, silver is oversold. So if silver is oversold, then it's likely to go up, and obviously gold will follow. Now, we would have needed some form of fair value gap here. We didn't have it. I'm curious if we had any on the 1 minute though. I told you I haven't checked the charts at all, and I also want to see the 1 minute. Oh, silver. See exactly what highs, what lows we had the. Okay, so this is the divergence, or the divergences that we had. So we had in here bullish continuation divergence where gold made a higher low and silver made a lower low. Okay, these two lows. And then we had another one where gold made relatively equal lows. Now, remember how I told you that you should mainly be looking at the bodies, if you were to consider the bodies relatively equal. Okay. See? And silver bodies again, right? You can see that is creating lower, right? Now, in this case, this divergence, in order for it to make sense, so that one where we have a continuation where gold is making equal lows in this case, silver should have made a higher low like this, because for the bearish side of it that we just explained a little earlier, gold was finding resistance, so it was creating equal highs, and silver was not going any higher, right? So in this case, it should have been silver creating a higher low, not a lower low. Okay, so I guess this is not part of it. I was going ahead of myself. Okay, so yeah, you could say that we had this thing over here. You could say, but I would not have traded that, because if you're just going to look at it like this on the 1 minute, you're going to find so many SMTs and you're going to find so many fair value gaps, and you're just going to go crazy. So yeah, that's why I want to stick to the 5 minutes. Okay. So from a logical perspective, what I would want. Yep. Hey.
Is it the divergence not on the 5 minute where we're looking at the silver candle at 525?
Let me check.
For the fair value gap.
Well, wait, because I think that we already have a divergence. So I think here, okay. Yeah, this one. So we have, you could consider it that we have lower highs here, okay? Sorry. Equal highs. Okay, and we have lower highs on silver. Okay, so this is a bearish continuation divergence. But again, think of it like this. How can something which is bullish continue to be bearish? This is just showing you weakness, temporary weakness, okay? And at the same time, just look at these two highs that we have here. Where is our fair value gap? It's on the first leg. Okay. Also, what I can see now, it's not something that I would necessarily consider, right? But it just blends with the current logic, is this fair value gap that we had. And this fair value gap formed during the same candle, okay, in here, the 8:05 candle, New York time, okay? So it would be here. Now, we don't have an SMT here, or we didn't have an SMT before we had this one that I marked with red, right? So when this fair value gap, this one formed, we didn't have an SMT yet. However, what we did have was silver going above an old high, where we know that it finds what? Buy side. So now we want to wait and see, how is it going to use that buy side? Is it going to use it as fuel to continue to go higher? Okay, or is it going to use it to pair it with smart money shorts, case in which it should create a bearish imbalance? Okay, so in this case, seeing this fair value gap being created on silver after having reached an an old high, okay, if it's going to be respected, then it's a big likelihood for price to want to go down. Now, we're not trading silver because so far only silver makes sense from a buy side liquidity perspective to take a short trade, right? Because again, buy side, old buy side, and then it's showing a bearish imbalance and goes up into it and respects it, right? So if we want to trade gold, which it's not something unusual that it went above an all-time high, right? And it's just creating new all-time highs, but that doesn't mean that we should sell it, right? However, this indication on silver that it wants to use the buy side that it just found to pair it with smart money shorts could indicate that we could have possible weakness incoming on gold as well. So what we would need to see to confirm that idea that we might have possible incoming weakness on gold is a bearish continuation divergence, or even better, when silver would have gone into this fair value gap, okay, gold would have gone higher, and then it would have formed a fair value gap on the second leg. And then we would have had gold creating a higher high during this peak, this price leg. And with the same price leg, silver did not create a higher high, but it did stop into this fair value gap. We didn't have this reversal divergence, but we do have a bearish continuation divergence, which again, for the 100th time, it doesn't make sense to continue bearish since your market is bullish, but we can make sense of it by considering that there is incoming weakness, okay? But we could not have considered any short opportunity without or prior to having this divergence. Okay, and in this case, we had the fair value gap on the first leg, and then the divergence is confirming this fair value gap. Okay, makes sense? So now maybe you're gonna ask, Alex, how are you going to trade this? Maybe what I would do would be the following two things, the following two scenarios, depends which one would occur. I would wait for this fair value gap to form, this gray one. So therefore, we're going to wait another 2 minutes for this current candle to close, then wait for a rebalance of it, and then either wait for an entry candle or not. Or if the fair value gap is not tapped, I would probably consider taking a short as soon as price breaks under this low and take it with an impulse if it breaks this low, because we could also have the other scenario in which silver already broke under that low and gold will not, and we're going to have a bullish fair value gap in here. Okay, and then silver is going to go down into the fair value gap, and this is going to go lower, and then we're going to have our entry confirmation for a long. Okay, so either play it. Okay, it's probably gonna do this like that, and where I would have my stop loss probably above this current candle. And I would not expect it to go up and rebalance that fair value gap, or at least I would not want it to see that, to see it do that. Now, because this is just a continuation divergence, so in other words, it's not necessarily it's just showing temporary weakness, okay? What I want to do now is I want to go to the higher time frames, 30 minutes, 1 hour, and see where we have fair value gaps that were left open, right? That have never been rebalanced. We have one in here in the 30-minute, because you also want to see potential targets, okay? And if we go to the 1 hour, there's that one, the same one, and I think there's one in here. Yeah, there's one in here as well. Okay, so when price would reach around these areas, I would probably consider taking some profit if I would enter the trade. Okay, so this would be it. Stop loss above there. And you can see you don't really have so much room for this, okay? For the, how do you call it? For the TP. Not too much room for the TP. Seeing this current candle continue to move lower after it went beyond that low. And let me just remove that liquidity area. After it went beyond that low, okay, seeing it extend to move lower, you're not really considering price to, you know, switch this current candle bullish. And if it's going to do it, you don't want to be in the trade. So I would say that it's safe to put the stop loss right now just a little above that high, above that candle's high, okay? In here. So here we would have like a little above 1R. I honestly would not be so happy with it. So maybe we can, okay, we're seeing some momentum coming. I'm sorry for these pauses that I'm making, you guys. But I'm doing so many things at the same time. Okay, so we like the momentum, okay, but we really want to, so this fair value gap, we can just remove it because it just punched through it without even caring about it. And let's see when it reaches into this fair value gap, okay, the one on the 1 hour. Okay, so more than 1R at this point. Now I see another imbalance left open here on the 5-minute. Let's see what's it's going to do next, if it's going to get there. Okay, so let's bring the stop loss at break even now. You also want to check, like when gold reaches into some form of PD array, like it did right now, it reached into a 1 hour fair value gap, okay? And the other stuff that it would have from a slightly higher time frame perspective would be, you know, London low and maybe this intermediary low over there, okay? So London low, Asia low, and if it goes lower to yesterday low there, okay? Now, when price reaches into 1 PD array on gold, okay, you also want to see like what could give you like an indication whether it's going to reject from there or not is you want to check silver. Where did silver reach? Did it reach into something relevant? Okay, like for example, what I see silver doing now, it reached into this fair value gap, okay, which is that fair value gap was what? That was a turning point. It was the imbalance that caused this entire price leg to go up above that old high in here, okay? Let's just put this like that. All daily high. Okay. So we don't want gold to reject from here, right? But definitely we either don't want to see silver rejecting from here. Okay. Now then we have this London low for silver. Okay, right now I really want to check the 1 minute, see what is going on. Okay, so we formed this thing in here. It might want to rebalance that, although I would not want to see it rebalance in here, because if it does that, think about what that would mean from a price action perspective. We're in a 1 hour fair value gap, and you would see price reject and think that a 1 minute fair value gap is going to stop it, right? Like, it's like thinking that a 1 minute fair value gap is going to be stronger than a 1 hour fair value gap that it's rejecting from. Okay, so honestly, I would not want gold to want to go in here, because chances are this fair value gap is really not going to hold. Why? Because to go up there into this 1 minute fair value gap, it needs to reject from a 1 hour fair value gap. And I don't think that that 1 minute fair value gap is just going to resist price from rejecting from a 1 hour FVG. Okay. And also you can see silver rejecting from that fair value gap that it left in here. Let's see silver on the 5 minute. So it's really, really important to adjust your analysis as every candle is going to form. Okay, it's really, really important. Oh, wow. If this is going to go lower than here, okay, then this might actually be really cool. Now, what we have as an obstacle right now is this, which I would now consider that candle as an order block. Okay. Okay, this the candle that formed 2 minutes ago, like the 914 candle. I would consider that an order block. And the midpoint of this candle, if we could just close under it, then I'm pretty positive that. Oh, did we close under its midpoint? Did we now? No, not really, but we might do it. I don't know. We'll see. Thing is that you don't want to see price rejecting right now, because if it's going to do that, you had the 1 hour fair value gap. Okay. And when it reached into it, it created this 914 bullish FVG. Okay, yeah, it's going to continue lower. Okay, because look at the dynamics of this current candle that's forming right now. Okay. Might have gone ahead of myself, because for now, just look at what silver is doing. You see, it formed this BISI here on the 1 minute. And as silver stays locked into that BISI, gold is going lower. Thing is, the good part is that we have, I want to go back to the 5 minute and see where we initially had our stop loss. Okay, so initially, oh shit. How do you pick this up from here? Okay, like that. Okay, so we initially had our stop loss above this 905 candle. Okay, and then we brought it above the 9010 candle on the 5 minute. Okay, so till here we had a 2R and 3R and getting very, very close to this intermediary swing low, this one. Okay. The good part is that we are smashing through the higher time frame fair value gaps. Okay, this is the good part. Now, still, don't forget that this was a bearish continuation divergence. So it's not necessarily showing you a reversal, it's showing you a weakness. Okay, so even though for now there are no other 1 hour fair value gaps that we might be looking at, okay, this is still just a weakness divergence, a divergence that is indicating weakness. So now I want you to think about the possible draws on liquidity, right? So we have that intermediary swing low, right? Then we had London low, this, and then we have Asia low, and then we have the low of yesterday. Now I want you to look at the previously and the last most recent higher highs. We had this high, and then we went above it with that high. What's the lowest low in between these two high? It's this one over here, yesterday's low. Okay, so there's a big likelihood that this push to the downside would not necessarily want to attack yesterday's low, because if it does that, then like we're not expecting it to do that. Why? Because according to these two highs, this low is a protected level. Okay, it's a protected level. Therefore, we're not expecting it to be attacked. If we would have had a reversal divergence on gold, where gold created a higher high and we had the fair value gap on the second leg, and silver created a lower high, okay, right? This would have been a reversal divergence for gold, right? So in that case, there would have been a big likelihood of the protected level to be attacked, just like we've seen with the previous daily / 4 hour example that we just randomly picked from the chart, okay? Just like there. Right? But we did not have this type of reversal divergence. Okay, so because of that, I'm not really expecting, for now, with this move, I'm not really expecting for gold to attack yesterday low. Okay, does it make sense, you guys? Okay, I really hope it's making sense, Edward. It does. Pre-news manipulation. Yeah. Okay, so we went through the 3 types of divergences, okay? Only for the bearish side, like we only talked about bearish divergences, but it's needless to say that you guys have to flip everything over for the buy side, okay? For the bullish divergences, right? And like I said, just seeing an SMT and a fair value gap does not mean that you have a trade. It needs to follow the narrative. And now that you know what the narrative needs to be, which is what ICT kept on talking to us, and we just had no fucking idea what he's talking. What is this guy saying, referring to when he says the narrative? It has to follow the narrative. This is what it means, okay? Your narrative is going to be, what type of market are you in? Bullish, bearish. Perfect, you discovered that. Now, what type of SMT do you have? Bullish, continuation, bullish, reversal, bearish, continuation, bearish, reversal. Does it make sense in your current context? Does it make sense? Does your drawn liquidity make sense based on what type of divergence you had? Okay, because sometimes you will feel very confident that the drawn liquidity is, and I'm sure that you've also seen ICT being crazy confident about the drawn liquidity is here. And then in other occasions, with other situations that look exactly identical to the one in which he was sure that the drawn liquidity is going to be this particular low, with this similar situation, he now says, it's not obligated to come under this low. So the drawn liquidity is not necessarily that low. So now you're thinking, or I don't know if you have been thinking about this, why sometimes it makes sense, why sometimes that's the drawn liquidity, and sometimes even though the case is identical, or so it seems, that's not the drawn liquidity. This is the differentiation, the factor that makes the difference, okay? The narrative. Because, and I, with the risk of repeating myself, if you're in a bullish market and you see a reversal divergence, chances are, big chances, that the protected level will be your drawn liquidity. It will be attacked eventually. And it's not something that that's not going to be your drawn liquidity for like that particular price move. Because if you're looking on the 4-hour chart or on the daily chart or on the 1-hour chart, that's going to take time to develop. Because maybe it took price 2 weeks to form a swing low that is a protected level on a 1-hour chart. Okay, maybe it took 2 weeks to create all of that. So you're not expecting that low to be attacked on the 5-minute just because you had a 5-minute reversal divergence, right? It's going to take, again, time to develop that move. Okay, so also if you're seeing a reversal divergence, a continuation divergence, but on an opposite market. So what I mean by this, the market is clearly bullish, but I see a bearish continuation divergence. It doesn't make sense for something which is bullish to continue to move bearish. Something can continue to move only in the same direction. So it means that if I have a bearish continuation divergence in a bullish market, that's not telling me that it's going to reverse or that I should not consider it because it doesn't make sense. It's just telling you that you will have a temporary weakness in the market. And okay, I've already said this so many times. So that's the logic. That's the narrative. Okay, the logic and the narrative. Okay, guys. So once again, if you have reversal divergence, okay, you want the fair value gap to be located on your second leg, okay? If you have a continuation divergence, your fair value gap, you want it to be on your first leg. Doesn't matter if it's a continuation divergence in a market that makes sense, or your market is bearish and you're having a continuation bearish divergence, okay? No, so in this case, if your market is bearish, you have gold creating lower highs, and you have silver, which is also bullish, but silver creates a higher high, okay? In this case, you don't necessarily want silver after going above that high to create you a fair value gap on this price leg, right? Because you're not trading silver. What you do want is that as gold goes up into whatever fair value gap that it might see in here, that you might have here, silver is going to go above the high that on which, you know, above that high that, you know, gold, when it created that high, it created actually your fair value gap. Okay, that's what you want to see, right? So gold stopping into a fair value gap and silver sweeping liquidity. Okay, this is a continuation divergence. And at this point, you want the fair value gap to be on your first leg, on the first or after your first swing high. This is the swing high, and after the first swing high, you will have a bearish leg. And then this was your second swing high, and you have your second bearish leg. Okay, that's the logic. Okay, guys, I think we can stop here. We explain everything. If you guys have questions, please go ahead and ask me.
Hold on, just one more thing.
Okay, let's see.
No, I'm only joking.
Funny. Okay. Okay, guys.
Well,
thank you very much.
Yeah, absolutely, you can.
Thank you.
About the stops.
The stops. Okay.
Can
The
we
stop
just
losses, right?
Yes.
Okay.
Please.
Okay.
Can we quickly cover them, or I'm gonna go through them from the notes that you you know, like sometimes if it touches the order block or if it doesn't touch the order.
Okay, so here's the thing. In this situation, okay, in today's trade, this one, okay, in this trade, I said that I'm going to put the stop loss right above this candle, because if price will create this fair value gap, and before touching it, so before rebalancing the fair value gap, it's going to want to go down, basically, plus other factors, okay, it would make this fair value gap to be a breakaway gap. So you don't want breakaway gaps to be rebalanced, because chances are price will eventually just disrespect them, okay? Now, what is a breakaway gap? Breakaway gap is that fair value gap that, how should I say, the price action sitting under the fair value gap, right? So in this case, this one, price action sitting right under that fair value gap is already balanced. So what I mean by this is the following. A fair value gap, we know that it is an imbalanced price range, right? Not a balanced price range. right? Not a BPR, but an imbalanced price range. So we have mainly sell side being offered during that candle's trading, and we have little to no buy side being offered, okay? However, the wick of this candle comes and offers buy side throughout a portion of this candle's body, okay? So that candle's body is from here till here, right? And for about half of it, that this market is offering the buy side. Why? Because this wick goes up, therefore it offered the buy side, okay? So at this point, the portion between this candle's low and this candle's high, that's already balanced, right? Because you have buy side being offered and you have sell side being offered, okay? Or you had sell side being offered and then you had buy side being offered. It doesn't matter. You have both ends of the liquidity of the movement being offered, right? The buy side and the sell side, right? So this portion in here, from there till here, it's balanced. So you don't want to see price going above the balanced range. So this is what would make that fair value gap a breakaway gap, okay? Now, maybe you're gonna say now, Alex, but it's the exact same thing that happened with this fair value gap. You see this one, right? Because this looks absolutely identical. This candle is identical to that candle, and this candle is identical to this candle, okay? Absolutely identical. However, the difference is that when the fair value gap formed, okay, the fair value gap formed in here, and we had this low being formed, okay? Now, before breaking this low, price went up into the fair value gap, right? However, in here, we had this low being formed, okay? And we had this fair value gap being formed. So if price is going to break under that low after the fair value gap was created, okay? Chances are that it's breaking structure. In other words, under this low, you would consider it a minor structure. So it's breaking the structure because it has no interest in going higher to rebalance before breaking lower, okay? Nimesh,
Yeah.
thanks Alex for this call. Have to go and do the school run. Okay, you go, that's okay. Remember everyone to backtest, definitely guys. So this is a very good advice from Nimesh. Remember everyone to backtest this and train the eyes to see this formation. My old mentor used to make me show her 100 setups of a particular formation. That's really good. And if I got one wrong, then she would make me do it again. I used to hate it, but now grateful as I look at the charts differently. Therefore, the key is to train the eye to see these formations that Alex is describing, and he's absolutely right. Okay, he is absolutely right. Absolutely right. So guys, once again, if the fair value gap forms, okay, just like we have this one now, and before jumping into rebalancing the fair value gap. So let's say we didn't go up to rebalance the fair value gap, but we did break that low, because this is exactly what happened in here. Okay, the fair value gap is created and you have this low, right? So you didn't have the fair value gap created and then the low, okay, right? And price didn't go into the fair value gap, but then it broke the low. Because if that happens, then this becomes a breakaway gap, okay? In this case, we had the fair value gap forming, okay? And before going up, so the fair value gap was created after that candle closed, okay? So after this candle, we still could have gotten a candle going up and then break that low, okay? Case in which obviously this would not be a breakaway gap anymore, right? But because the fair value gap is forming and prior, you have a low prior to that, okay? And prior to rebalancing the FVG, price first goes down, breaks the low, chances are that fair value gap will not be rebalanced anymore, okay? And you don't want it to be rebalanced if you want your bearish idea to still make sense, because that's the purpose of breakaway gaps. You don't want them to be filled, because if price will fill them, it's like you would consider this low to become protected, so you're not considering that, oh, it's going to reject from that low and then it's going to go lower and break that low. Chances are that's not going to happen, okay? So you see, you have in here on silver, you have the fair value gap and you had that low, okay? So prior to breaking the low, first price went up, rebalanced the fair value gap, and then broke the low. Okay, so that's obviously not a breakaway gap. Okay? But in this case, that's why I said, if price will form this fair value gap, because that's how I said that I would enter. If price forms this fair value gap, and prior to breaking that low, it will rebalance it, then I'm going to take a short entry. Okay? But if price, however, forms this fair value gap, and it doesn't go, let's rebalance it, but prior to that, so forming it, still continues to go down and it breaks that low, then I'm going to take an impulse entry. Why? Because I know that I don't want price to come above that high. And this is precisely the reason why initially the stop loss was above that candle. Okay? Initially, the stop loss was like that. Why? Because since that is your breakaway gap, okay, the moment price steps above this balanced area from that candle's low to that candle's high. So the moment price goes into the territory of this FVG, you know that your trade idea is invalidated, which means that this was not a break of structure, so to speak. And me taking an impulse entry as soon as that low is broken was a bad idea. Okay, but now just look at how that level is just keeping price there. I'm not saying it will just continue to keep it there, but for now, it's pretty relevant. Okay, for now, it's pretty relevant.
Alex, just quickly, are
Yes.
you going to send this recording on our group?
I will.
Yeah, so we'll all have access to it because it was
Absolutely.
a long video and
Yeah, you will have access to it. Yeah.
brilliant. Thank you.
Sure. Okay, guys. Questions? Anyone else has questions? Okay, I'm going to assume not. I hope you enjoyed all the explanations, and I hope that these are going to help you. Now, there's going to be people in the chat who are going to want to jump right into this without backtesting. Just don't. I would rather you keep asking me stuff. You know, I'm very good at not yelling at you guys. If you will say, Alex, is this analysis correct? Or, you know, but if you guys are just gonna say, well, isn't this the FVG, or isn't this the setup, isn't this the FVG, isn't this the SMT, is like you're trying to say, well, Alex, you're saying this, but actually isn't this one. Okay. So you guys can send me questions. Okay. I would rather you send me questions than assume that this SMT plus this FVG is what you should be trading. Okay. Rather ask than assuming, because I know it's going to take time until you would get used to this thing. And I know that most likely many of you are going to try to apply it mechanically. Okay, so Alex said that we're going to have this high, and the fair value gap should be on the first leg or on the second leg, and I'll just have that and that's it. But there is, like you've seen, it's more to this, okay? Again, the narrative. The narrative, you guys, is the most important part. Okay, so just don't forget about it. Rewatch this recording, because like I said, I'm going to send you the recording. Rewatch it as many times as you can, and just ask me questions, okay? Just ask. I'm here to answer. Okay, I'm just gonna stop for now. So yeah, talk to you guys later in the group or whatever. And if you, just backtest this before you apply it, or not even backtest it if, I don't know, if you don't feel like it or you don't know how to do it, but simply just go back to the chart where turning points have occurred and just see if you had an SMT and where the fair value gap formed and whatever, okay? Because just gather examples from whatever has already happened in the chart and then just analyze it, because it's really, really going to help you a lot. Okay, you will never learn by just hearing someone preaching the theory into a video. You're never going to learn like that. You're never going to learn either if you're going to see me how I do it in the chat, and if I'm going to say, well, I did this and I did that and whatever. Looking at someone doing it is not like you're doing it. Okay, and it just has zero benefits for you. Trust me, even though it can seem as if it has a lot of benefit for you, that's just a dopamine. Okay, it's like your dopamine tricking you that, oh, yeah, it's like I'm doing it. It's like I know. Okay, Matt, I have a silly question. No question silly, I hope. How do you add the dashes to the middle of the FVG in trading view? Well, you just put the FVG and you have this settings in here, and you have on the style tab, you have this middle line and you have to tick it. And then you can say how it's going to be line, dash, or dotted. Yes, you're welcome. Wow, someone literally asked me how to do something in TradingView. Okay, guys. Talk to you later, okay? Have a good one. Bye.
Bye. Thanks.
Bye.